Hey guys, what's going on? Welcome back to my channel. Today we're going to be talking about extra payments towards your mortgage. Is it better to make additional payments every month or wait and do it once a year? The same amount, but just monthly or annually? Let's get into this. All right, so I found this amortization schedule that I can use online. So let's assume that we have a $200,000 loan. We're going to go traditional 30 years. That's 360 payments at a 4.5. So let's calculate to see what that looks like just in general. All right. Okay, so you're looking at your monthly payments here of $1,013 with 37 cents. Your total principal payment, which is what you're gonna pay, is $200,000, and your interest is $164,813 with 42 cents. All right. So it does say here, if you do the schedule, it'll tell you that you will not finish paying this mortgage off until March 23rd of 2051. So let's go ahead and plug in these numbers in the spreadsheet here. So we have the extra payment calculator. Again, it's a $200,000 loan at 30 years. The principal is $200,000. On all three scenarios, you're gonna end up paying the principal for sure. That's $200,000. The difference here is gonna be the interest, right? So for in the traditional one, we're looking at paying $164,813 with 42 cents. So when I plug those numbers in, it's going to show me that my principal plus my interest, I ended up paying $364,813 with 42 cents towards the traditional loan, meaning you didn't make any additional payments at all. You just stayed true to the payments. And here it says that it'll be March 23rd of 2051. So we go 2051. March of 51. Okay. So now the beauty about these calculators online is that you can say, you know what? I want to add a payment. Here it gives you the option to add to your mortgage payment as an extra yearly mortgage payment occurring right? Or as a one-time deal. For this one, I want to add $100 to my mortgage payment every month until I pay it off. All right, let's see how the numbers change. And I'm going to do this March because we started with March in the other one, right? So let's go ahead and calculate. The payment still stays the same up here, but look at the difference here on the bottom. Now we're looking at $200,000 for the principal, of course. But now instead of 164, now we're looking at $133,067 with 96 cents. All right, so now you're starting to see a little bit of a difference. The difference between a traditional and giving $100 a month from the beginning of the loan, you will end up in the end saving yourself $31,000 of pure interest. This is just interest that the bank is going to get from you if you don't pay early. All right, so your total amount went from $364,000 to $333,000. Let's see when it says it's going to end up. We're looking at March again of 2046. So you're looking at, so that alone tells you you're going to save yourself 5 years. So your 25-year loan, your 30-year loan just became a 25-year loan. All right. All right, so not too bad. That's actually pretty good. You're shaving yourself off 60 months worth of payments basically. Okay, but let's assume you say, you know what? I can't afford the extra $100 a month. What I can afford is when my income comes in, or when my bonus comes in, or when my raise comes in, I can afford to scrunch up $1,200 one time every year until the mortgage is paid off. Again, we're going to keep it in March. Let's see if there's any difference here. All right, so you're looking at here, you're still paying the $200,000 in your principal. Your interest actually went up. Look at that, 134, 199.97. All right, so if you look at this, your interest, your total interest that you paid here is $134,000. Your interest saved is $30,613. So it's close to about $1,000 difference. Doing it once a year, waiting till the end of the year to make that extra payment. And here you're looking at April which is for 2046. All right, so in the end, guys, a traditional one is not really the way to go. If you can afford to send $100 a month more, you're gonna shave 5 years off of your loan to begin with. That's actually pretty good. Now, if you say you can't afford the extra $100 a month because your budget is tight, like everyone's budget is, like mine is, like most everybody I know's budget is, but they do have that extra cash flow coming in at some point during the year, I could see yourself opting for the $1,200 annually. All you're going to be doing is extending the loan 1 month. So instead of paying it off in March, 5 years, you're going to pay it off in 5 years and 1 month. All right. So I hope this illustration has helped you guys make a better, more informed decision. And of course, if you wanted to, you could go in here and use this website to play with the numbers a little bit. What if I only can give $10,000 once? Or what if I'm going to give $300 instead of $100? This website will tell you, and when you click on the schedule payment, it'll actually give you everything, scrolling all the way down to where you should be towards the end of your payments and everything. So pretty nice, decent website. If you have any questions or comments, please leave them down below. But once again, thank you for watching, and please don't forget to like and subscribe.